Bedford Wealth Advisors, aligned with Cambridge Investment Research, is a concierge financial services firm located in Boulder County, Colorado since 1982. Gary produces a market and economic brief quarterly. Market performance is tracked using a unique, under-the-numbers approach. We study 5 macro drivers: capital, demographics, technology, global markets, and ecology. Here is Gary's market and economic brief.
Good day and welcome to our second quarter 2020 market commentary. The U.S. economy and capital markets, despite the coronavirus, COVID-19, both appear to be on clear, if uneven, paths to recovery. U.S. and international stocks, as well as bonds and real estate, all rose in the second quarter after sharp corrections in the first quarter due to the virus outbreak. Year to date, stocks and real estate investment trusts remain in negative territory, while fixed income and bonds are positive, typical of a correcting equity market. The U.S. economy also appears to be recovering. Employment and retail sales data were positive. In May, U.S. unemployment dropped to 13% against a near 20% prediction, while the actual employment rate, which is the total workers either employed or looking for work, increased from just over 51% to just under 53%, a statistical significance. And more notably, U.S. domestic retail sales were up nearly 18% against an 8% expectation, and following a near 15% rise in April. And if we remove restaurant and food services, U.S. retail sales are only slightly negative, down about 1.5% year over year from the same period in 2019. And we commented at the end of the first quarter of 2020 that virus outbreaks and virus crises have rarely caused global recessions, defined as 2 consecutive quarters of decline in economic output. This Standard & Poor's 500 U.S. large company stock chart tracks global health crises from 1981 to 2019, including HIV, AIDS, SARS, H1N1, MERS, Ebola, measles. We see that the stock markets declined sharply at the outbreak, but then generally recovered in 12 months or so. None of these events led to economic recessions. So our summary: 2020 will continue to be punctuated by the coronavirus and economic disruption, including energy volatility. Here's how we look under the numbers. In terms of the ecology wave, COVID-19 crisis will continue. Treatments look promising. We're still awaiting possible effective vaccines. But we do have a wake-up call. The risk crisis of virus outbreaks reveals that the global economy is vulnerable to these types of events, particularly because of high technology. Moving into technology wave, initial emergency responses were generally effective. Hospitals were not overrun, though at first testing was slow and inaccurate. We're awaiting possible vaccine, although there seems to be a global mobilization to create vaccines fairly quickly, hopefully by the end of the year. The human side of things, the demographic. Hospitals appear secure. Economies are reopening, though some demographic areas remain high risk, particularly those with pre-existing conditions and over the age of 60. General health care is reopening after vital services such as cancer treatments were curtailed during the emergency response. Global markets is a big factor. Markets remain disrupted. Air travel is restricted, for example, and there's uneven national responses. The first quarter energy disputes have quieted because the price of oil has dropped substantially. Global supply chains may be reset in many areas, but of course the big story is the dispute, which has now expanded into a full-blown, even Cold War between the U.S. and China, the 2 largest global economies. The capital macro is also of concern. The Federal Reserve, the U.S. Federal Reserve, stepped in with massive lending and payroll support. and significantly increased the fiscal debt of the United States from probably $22 trillion to as much as 25. So investors beware. This is very worrisome to the intermediate and longer term outlook for fiscal responsibility, certainly. The crisis then exposed ecological risks that were always present, always there in the first place, and will continue to threaten global stability. Markets and economies are rebounding, but also resetting under new parameters such as supply chain adjustments. This is a classic coordinated macroeconomic response. So how to respond in terms of your portfolios, your money? First, make no panic changes. Second, reevaluate your risk comfort. Try to restructure, if necessary, portfolios, but in advance of volatility. So let things recover and then rethink and perhaps re-engineer your risk parameters. Third, know and control what you own and how you own it. Fourth, use tax-efficient techniques as much as possible to reduce tax drain. And lastly, as much as possible, try to optimize your own health. Exercise, moderate nutrition, work with medical advisors. On the street, the word continues to be, don't panic, don't talk to strangers, don't touch your face, and don't touch your portfolios. As always, give us a call. You can read informative articles at our website, and they will be available in video format soon. Our firm is responding proactively. In 2020, we made a $1,000 donation to the American Red Cross. We're giving blood, and we're here for your calls. Thank you, and stay safe.